Hi everyone, this is Jason Burack of Wall Street from Main Street, and today Chris Marchese and I are going to be doing a treasure hunting for precious metal stocks podcast type of thing where we talk about macro, a little bit about the treasure hunting report that just came out, and some other things. So I'm very pleased to have Chris Marchese here with us. How are things out there in California, Chris?
They're looking pretty good. Summer's finally starting. And it's good to be back on the show.
Thanks, Chris. Just want to dive right in here immediately. You sent me the CPM, some of the stuff that you had edited in your notes from the CPM yearbook. So we heard on Financial Sense NewsHour, we heard Jeff Christian go over both gold and silver this week, and I was wondering if there's any other comments you'd like to add, that you haven't heard people talk about in the CPM yearbook, some things that you noticed.
Well, the numbers they have don't add up. I'll cite Eric Sprott on this one. He came out with a report, 5 or 6 months ago on the ETF demand where he lists all the major ETFs and how much they're holding. And they just don't match the CPM yearbook numbers. The CPM yearbook is understating them pretty significantly. So I don't really understand where they got these numbers.
It's very interesting. It's very interesting because I know in the past Jeffrey Christian had talked that Jeffrey Christian, went in there with the individual miners, and actually added up, the production numbers and stuff like that. So it sounded like Jeffrey Christian was being thorough, but, what's really confusing with me, Chris, and I don't know what you think about this, is that, every time Jeffrey Christian goes on, like Financial Sense NewsHour or one of those other programs, his price targets, he gives somewhat bullish fundamentals for silver, and then he talks it down with the price target.
Yeah, I don't even know if he knows his own product. I mean, silver is the best conductor of heat and electricity, so going forward, it's going to be a very important metal. As far as his price targets go, I really don't know where he comes up with this. Given those price targets, you should think every other commodity should be, a quarter of the price it is, given the supply-demand fundamentals relative to silver's fundamentals.
I think his price targets, Chris, I think a lot of them come from those mainstream, commodities analysts at the Wall Street firms who all want to talk down, silver. If you look at, some of those guys' price targets for silver, it's pretty ridiculous. I think they have, their 5 or 10 year price target, and it's below the current, market price by a lot. It's like $25 or less. So, take it with a grain of salt, especially like Jeff Christian giving out targets like that.
Well, it's logical. Just think about it. The industrial uses for silver are going up. The Silver Institute estimated an increase of, 5 or 6% compounded for the next 5 years on their base case scenario. Mine production, the growth in that is slowing down. Scrap metal from the secondary market, i.e. Indian scrap, is not sustainable in terms of the amount coming onto the market. So I really don't see a bearish trend going forward. If anything, everything indicates higher prices.
That's a good point.
Higher demand.
Those are some good points, Chris. And you mentioned to me before we started recording here about the COTs looking more bullish than you've seen in a long time. Is that right?
Yeah, I don't have the numbers in front of me, but it could be the best numbers I've seen to date.
The best numbers you've seen in years or ever?
Yeah. I mean, the whole silver market has undergone an enormous structural change. If someone were to take the time to learn how to read the COT and make the proper adjustments for spreading, you can see a huge structural change that's here to stay.
Very good, Chris. So look
going forward.
So you think then that, if we're not near a bottom, then we're, very, very close, and that people, should be either starting a position with, part of their planned position money or adding to positions here for sure then?
Oh, yeah. They'll be very happy in a few years.
They might even be very happy, Chris, right after if there's a QE3 announcement or whatever they're going to call it this time. So by the end of August, probably.
Yeah, sounds about right. But
okay.
That really won't be called a QE3. Bernanke may be dumb, but he's not that dumb.
Yeah, and plus he's a politician, so he's more of a politician now, like you were talking about that. So Bernanke understands, the elections only next November.
Yeah, if he wants to get reappointed, he'll artificially stimulate the economy, or at least he'll try once again. So everything looks rosy when Obama is up for his reelection, and which if he wins, Bernanke will remain Fed chairman. Otherwise, he may not. So he's going to do what is in his best interest, just like all these other sociopathic politicians.
Okay, so speaking of sociopathic politicians, Chris, I want to move over to other macro items here that, we get your comments on, like about, what's going on in the EU, what's going on in Greece, and some of those other pig countries there. And then we hear these stories, about the ECB's buying gold, and then we have a James Turk story earlier in the week about how the ECB is almost insolvent. So we're getting all these, conflicting data. I was wondering if you could just comment here on what the macro picture is looking like in Western Europe and some of the other areas that you're noticing. Maybe even China too, with their muni bailout.
As far as the EU goes, I think it's being overblown here to kind of mask our problems, although the EU has its own share. But just take the U.S., for example, comparing it to any of the pig countries in the EU, we are far worse off. So, I mean, it's surprising we're not talking about muni crisis here or treasury default, but we seem to think that's going to happen in the EU. We think we can defy gravity, but no one else can.
It's a good point, Chris. And, the world's reserve currency is going to allow the U.S. a tremendous advantage, as compared to most of the rest of the countries. And then when you have, the tricks that are played, with the inflation rate here, and, it's I think in the last, 6 or 7 months in one of the bills, they were talking about how they want to, change the CPI formula again because it's the CPI is saying that the inflation rate's too high for the politicians' liking.
Oh, yeah, they use so many really manipulative methods, geometric weighting, hedonics. They for some reason they think it's better to use core CPI, which removes food and energy, even though those are the most necessary things we need. If anything, we should be looking at just those and taking out everything else.
Those are some good points, and one of the best quotes I've heard was there was one of the New York Fed presidents or one of those guys that was at an event, and he was talking about how more efficient the iPad has gotten, and one of the guys in the audience yelled at him you can't eat an iPad. So he was like, who cares that the iPad has gotten 20% more efficient, thinner, lighter, and they substituted it and said it's not inflation because of that. You can't eat an iPad.
Well, iPads are great, but they do not add anything to productivity. They're just toys, and Americans seem to love just borrowing money and going to buy toys such as the iPad. But another reason why electronics like the iPad, personal computers have gotten cheaper is because the government has stayed out for the most part, whereas they stick their grimy fingers into everything else and make prices skyrocket, like healthcare, you name it. Anything the government's associated with is
education, college.
If you want to call it education, that's fine.
Let's not have that debate right now, Chris.
Yeah.
Yeah, that's a great point, about the technology sector is, there's a good amount of competition in there. You can definitely say, by looking at the past 10 or 15 years that the quality of goods and services offered in technology has improved, and the prices for them, you get a lot more quality goods and services for your buck. Like, you can get a really great flat screen TV now for under $1,000. I remember, 7 or 8 years ago when a small piece of junk, plasma TV was like $7,000 or $8,000.
Yeah.
So, yeah, you're just seeing, amazing, and that's what the free market is all about, Chris.
Yeah, it's unfortunate we have just small remnants of it left.
Yeah, I completely agree. I want to move on to some other topics here, Chris. In the treasure hunting report, we have like a past historical section here because we think it's important, that people study some of the past, financial panics, depressions, like inflationary, hyperinflationary scenarios. So what type of things are you seeing from other past historical events right now, that's going on right now that, you can look back in history and say, well, this happened from here and this happened from there?
Well, I look at it as a combination of the hyperinflation in pre-revolutionary France and the hyperinflation in 1990 with Argentina. With France, economic growth was stagnant, so they decided to start issuing papers, the assignat, instead of staying on hard money. And, a few people argued against it, like Neckar, and they were able to starve it off for a while, but eventually, everyone wanted paper money, unbacked, of course. And so they got their first injection, and economic activity picked up. Everything was rosy, and then another crash again. Sound familiar? And this just kept happening over and over in increasing quantities, but the effect was there's diminishing marginal effect, and the duration was much shorter. So it's almost like a drug addict injecting, heroin. The first time you do it, you get your biggest high, and then you got to keep doing it or do more frequently just to get the same effect, and eventually you overdose and die. As far as Argentina, I just say that because that's a good example of the electronic bookkeeping. The central bank can just add zeros onto the checking accounts of its member banks instead of actually printing money. So hyperinflation can happen very quickly. So I consider it a kind of a combination of those two occurrences. Not anything like the Great Depression, which most people seem to want to compare it to for some odd reason.
Yeah, those are some good points, Chris. Now the France events you're talking about, that's what later came to be known as the Mississippi Bubble Scheme, and that was with John Law, or is that a different one?
Oh, that's different.
Okay.
That was with Cantillon and John Law.
Oh, okay.
Yeah, that's another example. I mean, knowledge is obviously being lost because people are making mistakes over and over again.
Yeah, I mean, like when I look back in past financial, panics and stuff, I see a good amount of stuff, similarities between like Weimar. I see some stuff out of Weimar, some stuff, and then I also see some stuff from the 1970s, stagflation that the U.S. had. I see some of the stuff because we have a high unemployment rate, Chris, and it's increasing, and the Keynesians, right, and or the MMT people now, if that seems to be the name they prefer. And, they're talking about, there's no such thing as a lot of them are talking about there's no such thing as stagflation still. And we're seeing, high unemployment here, and we're seeing, increasing inflation. And, as bad as inflation is here in the U.S., it's even worse, like, in China, in the places where the inflation has been exported to, like China, India, and I think it's even like 28% inflation now in Argentina, or some crazy number like that.
Well, I mean, their rationale is totally not based on logic whatsoever. For the 70s or 60s stagflation, 60/70s stagflation, they blame rising prices on supply shocks. For example, in oil and gas, where there was a line, half a mile long at every gas station to fill up your car, but assuming you hold a money supply constant, if a good such as oil rises, another good necessarily has to fall. So they obviously printed a lot of money, and it was the creation of all this excess money and credit that led to inflation during a recession, so stagflation. So their whole argument is just, it's ludicrous. That whole school of thought's ludicrous, to be honest.
That discussion, to expand further, Chris, is, for another time and another place. Also to add there that, 1971 Nixon closed the gold window too, and our creditors, were getting, realized that like they couldn't get any more, gold from us.
Well, I mean, that was already when we went on Bretton Woods, the gold standard was basically over. I mean, it went to a gold exchange standard, which, I mean, it was a little better than what we have now, but I mean, we need to go back to 100% gold standard.
Yeah, Jim Rickards, I think, called that like the fractional gold standard or something still. So it's still, allowing, I guess, a certain, fractional percentage there.
Yeah, well, the higher reserve requirement you have for gold, so say you had a 60% reserve ratio, meaning you had to have 60% of your deposits backed by gold, you're unable to inflate as much as opposed to what we have now, 0, but we have a 10% reserve requirement. So banks just have to be able to cover 10% of their demand deposits. So, yeah.
Okay. I want to move on, Chris. I want to talk about financial repression a little bit, and also Gresham's Law and how these things are kind of related here. What's going on like right now, is Bill Gross and Carmen Reinhart and Rogoff, of Reinhart and Rogoff, and this time it's different. Reinhart, published a little bit more than a month ago, came out with this main paper that most of Wall Street and the rest of the financial community was talking about, calling it like quote-unquote financial repression. And, this is something that's common for a lot of governments, is that like they don't want to pay, real market interest rates on their bonds. They want to pay, below market interest rates and continue to keep on spending. But the way financial repression works is that the governments like the U.S. Treasury Department would just require the banks and the pension funds to buy a larger number of those treasuries at the lower than market interest rates. So what are your opinions of that type of impact on inflation scenario, and also like how will people protect themselves? And if you could tie that in with Gresham's Law, since you brought it up before we started recording, that would be great.
Well, and for financial repression, yeah, of course, the Treasury and the Fed want pension funds and member banks to buy treasuries, so it looks like, U.S. debt is still in demand. But what's also happening is the Fed will have a member bank purchase treasuries during an auction, and then they'll buy it from that member bank later. So it doesn't look like the Fed actually bought as much as it did. As far as Gresham's law is concerned, the good money will always flow out, and the undervalued money and the overvalued money will stay here. Bonds are overvalued; they're in a bubble. Meanwhile, everything else is good money's flowing out. China is accumulating hard assets, which is essentially money. So we've just dug ourselves into a hole we're not going to be able to get out of. The Fed's going to have to continue monetizing debt just to keep interest rates low. So.
Yeah, and Bill Gross had put on PIMCO's Twitter feed recently, he's saying that next week's Fed statement will likely stress, quote-unquote, extended period of time, quote, language, or even a period of interest rate caps. QE3 likely to take form of, quote, extended period, quote, language, or interest rate caps on 2 to 3 year treasuries.
Well, yeah, the Fed's whole goal is to keep the low end of the curve, usually the 1 through 10 year, relatively flat, and then have it steepen as you go towards the end of the curve. And in order to do that, they have to have you have to buy bonds, or other people have to buy bonds. The Fed sells bonds, or the Fed buys bonds. Sorry, and they want other institutions to buy them. So it's like they're working together to continue to manipulate the short end of the curve, which is essentially what they're already doing. They're already buying treasuries in QE1 and QE2 to suppress interest rates. The market's trying to force them up so people will save, capital will accumulate, it'll be invested in further down the structure of production, and real job creation and productivity gains will come about. But the government, our central bank, is trying to fight that, and it looks like they'll do anything to achieve that goal. And if that means collapsing the currency, then so be it. They just don't seem to care.
And Chris, do you think they're trying to target those interest rates on the shorter end of the curve specifically? Do you think that's because of the housing recovery or whatever? The Fed's trying to get housing prices back up, or trying to prevent people like with the alt-A's and the option arms from the reset there from like getting destroyed again?
Yeah, a lot of mortgages are tied to the 7 to 10 year Treasury yield, so they want to keep that part of the curve as low as they can. It'll also make servicing our debt cheaper, which, if interest rates were allowed to float, we would be running over $2 trillion deficit in a few years.
Okay. Chris, I want to move on now. I want to move back to gold and silver, and then more specifically talk about the Treasure Hunting for Precious Metal Stocks report. And, one of the main questions, and, you and me get this a lot from, a lot of people in our Facebook group there that we created for people who bought the report, and, also in general from other people who, contact us, is, we get asked, why is there a divergence, between the bullion and the mining stocks? Why aren't the mining stocks, we're starting to see a good amount of earnings. Are the earnings not good enough? Why do you think the mining stocks are not performing to the level of bullion? Is it because there's, a rocketing short interest? If you could just talk about that for a little.
Yeah, there's a short interest, but I don't think that's the only factor affecting it. The biggest thing I think is it's basically an emerging market. Mining, precious metal mining hasn't been profitable since the 80s, really, just until now. I mean, strong cash flow from operations are just beginning to come through, even though prices have been elevated for a while. And I think most analysts don't think this is going to be a regular thing. They all have long-term price assumptions of gold at 900 to 1,000 or silver 15 to 20. So there's not a lot of analyst coverage. And since the mining companies have, only a few are paying out dividends, and those that do are relatively small now, institutions and pension funds are more reluctant to buy it. So, I mean, I think all that combined is keeping these mining stocks down. And, to be honest, there could be something else. I don't understand why they are so cheap. The long-term historical gold to XAU ratio has been about 4.5, about 5 if you want to just measure over the last decade or so, beginning of this bull market. But now it's 8 times, which is just unreal. And, people that are buying up these mining stocks, even though it's hard because they're falling like a rock, will enjoy huge profits and appreciation in the going forward. I think it's just going to be like the tech bubble. We'll hit a mania at some point, and you'll see a stock you probably bought right down here $2-3, and it could be a few $100s easily.
Yeah, I think so, Chris. I think so too, Chris. Those are great points. And, just like the tech bubble and mania, this could actually, be bigger because of the currency crisis components and some of the other components that are involved. And then on top of that, a lot of those companies in the tech bubble, Chris, they didn't have earnings. Some of them didn't even have revenue. So, the earnings that we're starting to see, like, you made some great points there that I think the market, I guess, wants to see, earnings history, I guess, like 4 quarters, 8 quarters of this. And, once the market sees this and, you're starting to see the dividend increases from a Goldcorp, a Newmont, a Barrick, you're starting to see consistent dividend increases. That's going to, bring stronger hands into the stock, and it's not going to be as many momentum players for the most part. It's going to be more buy and hold people like, hey, they're going to raise the dividend, at least once a year. May as well hold the stock, buy and hold it.
I can add one more thing that's could be part of the reason. I worked at Morgan Stanley for a while, and which I was absolutely disgusted with, by the way. And the brokers were just like car salesmen. They would just push any security onto anyone just to get that commission. They had no idea how to analyze a company, how to value a company. No idea about economics, nothing. They were able to pass these ridiculous procedural tests to become a stockbroker. And they rely a lot on analyst reports. I mean, I remember a lot of them just going to Value Line, in-house analysts, or S&P, and just looking at what they had as buys, and then they would just push that on to their clients. It was disgusting, and unfortunately, it's widespread. So it's going to be hard to tell when these brokers wake up and start pushing miners onto their clients, which, I mean, I think is only going to happen once a lot more analyst coverage is shown in this industry.
Yeah, that might be signaling that we're in phase 3 and near the mania top then. As, more of the mainstream people get involved and the regular Wall Street people who don't really want to sell gold and silver stocks to their clients start. I want to talk about the spread trade, Chris, because, it's just talked about a lot, so I was wondering your opinions of it. The way the spread trade works for people not familiar is that most of the hedge funds have been, going long bullion, like physical gold and silver, and then short some of the mining stocks. But do you think that's going to reverse? Because there was a great article like a day or so ago by John Rubino, and John used to work on Wall Street, and, he quit because, he was tired of dealing with a lot of the stuff you talked about. And what John thinks is that the things are going to reverse, where John actually wrote a pretty convincing article, pretty convincing argument, where people should think about, shorting bullion now and going along the mining stocks as a spread trade.
Yeah, I read the article. It was good, but why would you short bullion? That's crazy. Go short treasuries. That's free money. But, I mean, there's going to be periods that the bullion outperforms, periods when the miners outperform. Now it looks like there should be a turning point relatively soon, or at least catch up for the miners. Because, but, it doesn't matter. There's just more time for people to accumulate more assets on the cheap. So, the market will work itself out in the end. So, I mean, for those who are getting frustrated, just be patient. The fundamentals are drastically improving. So, I know a lot of people pay attention to the price action, but it should be the underlying fundamentals what you really care about.
I completely agree, Chris. And you know what I try to do to prevent myself, from selling prematurely or panicking or getting too emotional about things is I try not to check, the value of my account every day or a couple times a day or 10 times a day. And, I know there's people that do that and, do it every day and all the time. And I think that's, the wrong way to go. What I try to do instead is, I read stories about the company, I look for the fundamental stuff. I read stuff about, the gold and silver markets, and, that's what's allowed me in the past to make big gains on some of the stocks in the past, like over 600% on First Majestic Silver when we took gains, and over 400% on Great Panther Silver. Because, if I would have just looked at the price all the time, on some of those stocks, like First Majestic Silver didn't even move, Chris, like for a long time. It didn't even move at all.
Oh, I know. I had written my first article about it when it was, $2.70, $2.80, and it took a while to move. But, I mean, those who got in and held and were patient, it served them very well. And First Majestic's a great company. It's going higher, so...
Yeah, and I mean, I just wanted to prove a point to people that, if you do your homework, if you do your research, if you're pretty well diversified to protect yourself from yourself, you have a certain X amount of companies in your portfolio and you're pretty comfortable with that, geographically diversified, etc., you can afford to buy and hold on some of these guys and, let management, let a Keith Neumeyer, who's, a quality CEO, one of the top CEOs in the industry, create value.
Yeah, another thing is investors should, instead of being discouraged by lower prices, they should embrace them. Try to keep some portion in cash, 10 to 15%, even if it's in just the GLD or another currency. And when you see corrections right like we are right now, I mean, you should be ecstatic. You get to buy them a lot cheaper than you otherwise would. And, it's hard for a lot of people to do that, but learning to do that will make you a much better investor. A lot of it's psychology. People get shaken out of their positions when the stocks dropped a lot. It goes back up, they buy back in, and the cycle repeats itself. That's why most people have trouble beating the market.
Exactly, Chris. And, I try not to be my own worst enemy. like I was telling you earlier, I just try not to check the prices all the time, and I focus, on whether or not I should hold the company, not by looking at the price action, but by, looking for the news stories and the other things. And, I'm not going to be right all the time, but I've made enough gains where, I've been a lot more right than I've been wrong.
Yeah. And, just you got to have a strong conviction for the case for precious metals to be in these mining stocks to begin with. So if you're just in there because of undervaluation or people recommending it, you're going to get shaken out at some point. You need to really understand why these metals are so important.
That is an amazing point, Chris. And, that's exactly why we wrote the Treasure Hunting for Precious Metals Stocks report, and why, I started Wall Street for Main Street, and, why you blog and stuff. We're out there, trying to help people as best we can. We don't want to see a middle class wiped out. We want people to have capital to survive like this mess. And, you have to have a certain amount of education in order to buy and hold the gold stocks. I completely agree with that. You have to know the banking system. You have to understand more stuff about the banking system than the average person. You have to understand, what's wrong with the money, some of these other points. And we talk about this stuff in the Treasure Hunting report, right?
Yeah. I think we did a good job with the fractional reserve banking. Every U.S. citizen should understand that. I mean, I don't think I know the average person doesn't even know what the Fed does. So,
Chris, unfortunately, I'm not even sure most people even know what have even heard of the Federal Reserve here in the U.S. I think that's how.
No, it's government mandated education. They want to keep everyone in the dark as much as they can for as long as they can to satisfy their own needs. They're sociopaths. They're crazies.
Okay, well, the education component and some of the other stuff are very valuable because, we provide a lot of information in the report and a good amount of education. But, most people, it's about the bottom line. So, so let's talk a little bit about a couple of the companies here. If you want to talk about a couple of the companies in the report, maybe for preview for someone who's on the fence about buying a copy of the report.
All right. Well, one of my favorite gold companies is Sandstorm Gold. It's run by the CEO is former CFO of Silver Wheaton, Nolan Watson, and he is just a prodigy. He's able to create so much shareholder value. It's amazing, and he started this company in 2009 just as a cash pool, and they've acquired some great streams. They're up to 6 now. None of them at full capacity. We've already seen a lot of upside. I'll talk about one really quickly. They paid, off the top of my head, I don't know, I think it was $13 or $14 million for a 20% interest in Silvercrest St. Helena property. And initially it was forecast to produce about 25,000 ounces annually, and so Silver Wheaton would get 20% of that. But then they came out with a 4-phase expansion project, 3 of which are applicable to Sandstorm Gold. First, they will increase throughput to 2,500 tons per day, so they'll be producing 40,000 ounces a year. Then they will further increase tonnage, get a new processing facility. Then that will increase production by an additional 50%, which will bring them to around 55 to 60,000 ounces a year. And then finally, the underground mine. There's not numbers out on that yet, but just assuming it's 10 to 15,000 ounces, Sandstorm's basically, instead of getting 3,000 or 4,000 ounces a year from Silvercrest annually, they'll be getting 15 in a few years. Just goes to show how good their management team is at finding companies paying a small amount that have excellent upside potential, and we've already seen that come out with St. Helena. A couple other notes on Sandstorm is they are a 100% gold royalty company as opposed to the others, and they don't pay income tax. So keep in mind when you're trying to do a valuation on them. Another company is another royalty company, Franco-Nevada. It's along with Sandstorm, Silverwheat, and Royal Gold, I think are all core holdings for the entire bull market. Has just transformed itself completely over the last 6 to 8 months. I'll just go over a brief history of some of the.
Chris, if I could step in for a second now, these guys are masters. Not only Pierre Lassonde at Franco-Nevada, but also Nolan Watson at Sandstorm Gold. These guys understand, distressed asset buying. Like they were deploying, a good amount of capital post-crisis, right, when the credit markets froze, and then they target, specific mining companies that have, production problems and don't want to go back to the debt or equity markets.
Yeah,
right?
Exactly. That brings me to the first stream that Franco-Nevada acquired as opposed to a royalty, which means that they pay an upfront amount, a few $100 million usually, if it's a big stream, and an ongoing fixed rate, usually about $4.50 per ounce of gold, but they get the physical metal instead of a royalty, which is paid in fiat money. So they paid, I think it was $80 million for 50% of the gold from Coeur d'Alene's Palmarejo property when after the financial crisis, when a lot of companies were distressed and Coeur d'Alene had no choice. So what happened is they paid $80 million in exchange for what was then a mine that was expected to produce 90,000 ounces a year, so it'd be 45,000 attributable to Franco-Nevada. That has increased twice, and now it'll be 110. So they'll get 55 to 60,000 ounces per year. But recently, last year, they discovered another high-quality deposit, Guadalupe, which is it's nothing's set in stone yet, but it's going to be an 80 to 100,000 ounce a year mine. So when all is said and done, Franco-Nevada basically stole this stream, paid $80 million, is going to get over 100,000 ounces of, or 85, 90,000 ounces of gold annually in a few years for 12 plus years. And they've done that many times with the Tasiast mine in Ghana. Redback owned and operated it. It was bought by Kinross. They can optimize it to produce 1.5 million ounces a year, which would mean 30,000 ounces attributable to Franco, and they hardly paid anything for that. Most recently, they acquired Gold Wheaton at an absolute bargain, and I was actually a little upset given the price as a Gold Wheaton shareholder also. Oh, yeah, I was very upset, too, as a Gold Wheaton shareholder, that's all the premium we got. Yeah, they paid about 8.3 times current year's gross royalties, and the average company usually trades for 20 times. So they basically stole that. And for those familiar with the company, we have the Prosperity Stream, which is the property is owned by Taseko. It failed to get permitting, but they have addressed all the issues that the government had. Have resubmitted the application if it does get approved. That's another 60,000 ounces a year for Franco-Nevada at $400 an ounce. So, I mean, if that goes through, it's going to be an absolute behemoth of a gold royalty company. So those are two of the picks. Of course, I go through them much more in depth in the report, but that's the basic outline.
Yeah, and we're also including your royalties valuation software that works in Microsoft Excel in there for, Franco, Royal Gold, Sandstorm, and Silver Wheaton. So people can, check the prices, and the way that software, is going to be beneficial to someone is, if the stock's still undervalued, Chris, I guess they're going to continue to accumulate the stock, right? And then if, let's say, a company uplists then to a major exchange and, it trades way above its fundamentals, becomes a momentum stock, all this Wall Street hot money, drives it up, 600%, like what happened to maybe First Majestic Silver or Great Panther Silver, then they could look at their, justifications on the fundamentals and say, well, I think it's time, to sell a portion of my position and move into, a more undervalued stock or something.
Yeah, well, for these companies, I would never recommend anyone selling the royalties during this bull market. 3 of the 4 pay dividends. Franco recently increased theirs 60%. They pay it on a monthly basis. So when you compound that, it adds up. They're going to keep increasing their payout ratios. These are absolute cash cows.
And it's paid on a monthly basis, Chris, to prevent the shorts from attacking the stock?
Actually, no, I just think it's it's more beneficial to shareholders. A lot of people reinvest their dividends, so they're not taxed at that point, and defer it into the future. And by doing that, you accumulate more shares, and the effect of compounding is obviously greater than continuous compounding is greater than annual compounding. So it's basically a better dividend policy than most.
Okay. Yeah, and I think Goldcorp has the same type of dividend program too.
I'm not familiar. I don't really follow the seniors a whole lot.
Okay.
So.
Well, I think Goldcorp does have a monthly dividend program too. But to summarize, the Treasure Hunting for Precious Metal Stocks report for everyone, its regular price is retail price is $110 a copy. If you have bought the Treasure Hunting report from us in the past, we want to treat customer loyalty. We are planning on growing this, report that we've had a couple versions of. We're planning on turning that, Chris and I are planning on turning that into a more full-time newsletter, along with hedging strategies for your gold and silver positions. And you're going to get a lot of value in here. You're going to get 15 companies that are a mix of gold and silver companies and a mix of different size companies, like a good amount of producers, like a few mid-tier ones, a couple seniors, and some of the better juniors.
Yeah, and back to the newsletter, if anyone is interested in how the format will be what it contains, what it will cover, just send me an email at Marchese, MARCHESE .Chris@gmail, and I will send you the first letter I wrote. It's a lot shorter than the regular newsletter will be, but it gives you an idea for what it will contain, and we're going to try to make it really affordable, so the average person doesn't have to pay $1,000 a year for a lot of those that are out there.
That's exactly right, Chris. We're trying to still make a profit, trying to balance things out, a win-win scenario here where people still get some of the information and not just long this company where they get hedging strategies here to protect themselves too, because it's important people have some hedging strategies. If you have a lot of capital invested, I guess you have to have a certain amount of hedging strategies so you feel better, so you can sleep at night.
Yeah, I mean, this comes along with I'm already doing it for the group, the treasure hunting group, for a limited time basis, but it comes with a mock portfolio, which I've been actively managing with miners. There's cash, hedges, and I think it was started on one of the worst possible days, and it's still flat. So
it's good.
I think those new to the industry can get a lot out of that. There'll be about 1 to 3 companies covered per issue with valuations, analysis, appraisal, etc. And yeah, you can, if anyone has any questions, just feel free to send me an email.
Yeah, or they can contact myself or Mo Dawood or John Manfreda, and if they want to buy, a copy of this treasure hunting report, they can go to the wallstreetfrommainstreet.com website, and there's a link right on there under products and services. It says buy the copy of the report. So we're going to wrap things up here, Chris. Thank you very much for your time, and hopefully the next time we speak, it'll be when gold and silver is a little bit higher, although, it's good to be able to have some cash and buy some of these stocks here. I enjoy being a contrarian guy. I don't like thinking like everyone else. It's just, not a pleasant thought to have to, think the same way everyone else does. Oh, I want to buy bank stocks. Oh, I want to buy, these stocks and all that stuff.
Yeah, exactly. Well, if the masses are fools, so don't get caught up with that. Don't watch CNBC. Don't watch Jim Cramer. Don't. Not
unless you want comedy.
And don't listen to most brokers out there.
Yeah, I agree. So, everyone, hope you enjoyed this podcast here, previewing the Treasure Hunting for Precious Metal Stocks report, and also, giving you a little macro update. And you're going to hear a lot more from Chris Marchese and myself in the future. Bye, everyone.